You had the money ready. You had finally made the decision. This was the week you were going to buy VOO, the Vanguard S&P 500 ETF. You opened the app, you looked at the price, and you quietly closed it again. Because something in your gut said, it is too high. It has already had its run. If I buy now, I'm the guy who clicks buy at the very top 1 week before everything falls apart. So you waited, and the market climbed higher. And now the decision feels even harder than it did before. If that is you, take a breath. You are not crazy, and you are not bad with money. You are feeling the most human thing in the world. It is instinct to stare at a chart that has gone straight up and expect gravity to kick in any second. But here's the question this video is actually about. Not is VOO a good fund? You already know it is. The real question is whether your money, your time horizon, and your retirement plan can handle buying it right now. Those are two completely different questions, and by the end of this, you will be able to answer the second one for yourself. Quick 30 seconds on the fund, then the decision that matters. VOO is Vanguard's S&P 500 ETF. It has a 0.03% expense ratio, about $3 a year on $10,000, and it holds roughly 500 of the largest companies in America. Apple, Meta, Nvidia, Microsoft, Tesla. You are not hunting for the needle in the haystack. You are buying the whole haystack. But broad does not mean bulletproof. VOO is still the stock market. Dividends do not erase market risk, and diversification spreads your risk. It does not turn a stock fund into a savings account. Next to a concentrated tech fund like VGT or a chip fund like SMH, VOO is steadier because it is not riding on one sector. But steadier is not the same as safe. In a real downturn, VOO falls too. And the honest context as I record this, VOO is trading within about 2% of its 52-week high. It has had a strong run, which is exactly why so many of you are hovering over that buy button and not pressing it. So why does a high scare us this much? Here is the strange part. We love a sale. Everywhere except the stock market. If your favorite TV gets marked down 30%, you feel like a genius for grabbing it. But when stocks go on sale, when the whole market drops 30%, nobody feels like a genius. Everybody panics, assumes it is going to zero, and sells. And when the market is near a high, we panic in the other direction. We call it a bubble and refuse to buy. We have somehow trained ourselves to fear buying when things are good and fear buying when things are bad. Now think about this honestly. If the market rises over the long run, and over decades it has, then it has to spend a huge share of its life at or near a high. New highs are not a warning siren. They are what a growing market looks like on the way up. Every one of those highs felt like the top to somebody. Most of them were not. That does not mean a drop cannot come. It can, and one day it will. I cannot tell you when, and neither can the very confident person on TV pointing a laser at a chart. A strong run tells you where the market has been. It tells you almost nothing about next month. So what do you do with cash sitting in the bank? You really only have 3 choices. Choice 1, invest it all now as a lump sum. And here is the truth most people skip. Historically, investing it all at once has beaten spreading it out about 2 times out of 3, simply because your money starts working sooner. But the data does not have to live in your body when the market drops 15% the month after you buy. Lump sum only works if you can sit through that without panic selling. If you can, this suits you. Choice 2, dollar cost average over a set number of months. Say you have $60,000. Instead of all at once, you invest $10,000 a month for 6 months. If the market rises, your earlier money grew. If it falls, your next $10,000 buys cheaper. You may give up a little growth on average, but you get the ultimate shock absorber against the one thing that breaks people, going all in the day before a drop. This suits anyone who knows they would lie awake after buying in a single click. And notice, choice 2 has a schedule, a fixed amount, fixed dates, a defined end. Write it down. Choice 3, wait for a crash or a dip. And I will be honest with you, because this is where so many careful people quietly lose years. I will buy when it feels safer is not a strategy. Because here is the trap. When the market finally drops, it will not feel safer. It will feel terrifying. Jobs are being cut, the headlines are screaming, and the same fear that stopped you at the high will freeze you at the low. the bottom of a crash is the least safe you will ever feel. People waiting for the perfect moment usually wait right through the recovery too. If you have been sitting on cash for months telling yourself you will get in after the next pullback, this channel exists for exactly this decision. Subscribe to Real Wealth Hack for calm, no-nonsense retirement investing, not miracle return promises every time the market gets dramatic. Now, before a single dollar goes into VOO, here is when the honest answer is not yet. Do not invest money you will need in the next few years. A down payment, tuition, a tax bill. If the market has a rough stretch, it can take years just to get back to even, and your deadline cannot wait that long. Do not invest before you have an emergency fund. That cash is what stops you from selling at the worst possible moment. Your car does not care that the S&P 500 is down when it needs a new transmission. Do not invest while you carry high-interest debt. Wiping out a 24% credit card is a guaranteed return no fund can promise you. And look honestly at what you already own. If your 401k is already stuffed with an S&P 500 fund, plus QQQ, VGT, and a pile of big tech, then more VOO may be doubling down on the same 10 companies, not diversifying. Finally, if you are retired and this money buys your groceries next year, it does not belong in an all-stock fund. Full stop. If none of those apply, the real question is your time horizon. And this is where age comes in, but not the way you think. In your 30s, 40s, or early 50s, with money you will not touch for 10, 15, 20 years, today's price barely matters. Look back at the highs people were scared to buy years ago. From here, those prices look like the clearance rack. Over a long timeline, the daily noise fades, and your real risk is not a dip. It is inflation quietly eating your cash while you wait on the sidelines. In your late 50s or early 60s, it shifts. You do not have 15 years to wait out a brutal bear market, so you get surgical. Split the money into jobs. The cash you need in the first few years of retirement stays safe. The money for year 10, 15, 20 still needs to grow. And if you are already retired, same logic sharpened. Protect the near-term money. But some of your money may still have a 20-year job to do, because inflation does not retire when you do. Notice the pattern. It was never really about your age. It is about when each dollar has a job. A 62-year-old in good health can have a longer horizon than a 45-year-old retiring at 50. So here is the plan. 3 steps, tonight at the kitchen table. Step 1, find the money that is truly long-term. Subtract your emergency fund, subtract big upcoming expenses, and land on the amount you honestly will not touch for 7 to 10 years. That, and only that, is what we are investing. Step 2, pick your method, lump sum or written schedule. I am not going to tell you lump sum is always best. The math leans one way and your nerves may lean the other, and both are allowed. If you choose to spread it out, automate it. $2,000 on the first of every month for 6 months. Put it in writing. Step 3, set the rule before the next scary headline, because there will be one. A written plan gives you something better than confidence. It gives you rules. And rules matter precisely because confidence disappears at the exact moment you need it most. So, VOO is near its high. Is it too late to buy? For many long-term investors, no. Not because the chart is high, and not because the market feels expensive. A high price by itself tells you almost nothing about whether VOO fits your plan. But that is not a green light to panic buy either. You do not predict the market. You prepare for it. And for most people, the expensive mistake was never buying a month before a dip. It was sitting in cash for 5 years, waiting for a perfectly safe moment that never came while inflation quietly did its damage. There is no perfectly safe entry point. There is only a plan that fits your life and the discipline to follow it when the market tries to talk you out of it. So do not let a high chart rush you, and do not let it freeze you. Know what the money is for. Choose your method, set your rule. Then go live your life and let the 500 biggest companies in America go to work while you sleep. So tell me in the comments, are you buying now, dollar cost averaging over the coming months, or waiting for a dip? And more importantly, what is the rule behind your decision? I read every one. Quick reminder before you go, I am not a financial advisor, and this is education, not personal advice. Everybody's situation is different, so do your own research or talk to a qualified professional before you invest. But sure thing, I do the research to give you a soft landing. This is Real Wealth Hack, and I will see you in the next one.